Hi, this is Robert, and today I'm going to talk to you about the third quarter of 2021. It was an interesting quarter, and the big takeaway is that interest rates and inflation were the big topic of the quarter. And so there'll be a few slides a little bit later on in this presentation where I'll highlight sort of what's been happening with interest rates and also this fear of inflation and how that might affect the markets going forward. So we'll have this slide, which of course I always include in the presentations. This looks at the last 12 months, and it just shows what the market's done over that time period. But more significantly, it also, we've pulled headlines over that 12-month period to sort of look at how headlines don't necessarily translate into market expectations. So you can see, I will highlight a few of these areas here, that, for example, Biden was elected and took office, I should say, in January, and you remember all of the turmoil that occurred January 6th with the Capitol riots and everything else that occurred over that time period. And you can see the markets had very little reaction. I recall on January 6th, watching what was going on, as I'm sure the rest of you were too, of what was happening in Washington, D.C. And at the same time, looking at how the markets were responding. And they didn't respond. In fact, the market was up that day, despite everything that was going on. And you may think that, well, how could that be? And that was a similar sentiment that I had heard throughout last year, when we saw just the devastation of COVID, the headlines that were coming out, the markets didn't respond. Initially, they did when there was fear and uncertainty in March, February, March, April. But quickly the markets recovered from that big drop, and they were much more forward looking. So all this is to say that the markets are not looking at what's happening today. They're looking at what might happen tomorrow. And because of that, this is why you can see really negative headlines today and the market continuing to go up. This isn't always the case, but that is often what happens. So here's an example. US inflation is highest in 13 years. And so market didn't respond. I will say the overall market didn't respond to this, but certain sectors of the market responded very drastically, actually. And we'll look at that a little bit. So this is, again, I like this. You can see the steady progress, even though day to day, it doesn't feel like a steady progress. We're not day traders here, right? We're looking at longer term trends. And so this is the trend that we like to see. So we'll look at the next slide, which looks at, this is basically how the stock market has performed over the last 50 years. And so again, despite lots of events, we had the 70s with stagflation. We had, of course, in October of '87, this big market drop that occurred. They call it Black Monday. We had the bull market run of the 90s with high-tech stocks that peaked in March of 2000. And then we had several years, actually, of market declines over that period. And then we slowly started inch our way back up, only to be faced with the housing crash and the economic financial crisis that occurred in 2008 and 2009. But since then, it's been a steady rise up. This big drop here, of course, last year, COVID, market dropped 34% in 2020, in March of that period. And then we saw a rapid acceleration and gain over that period. So we'll look at US stocks. This is just for the third quarter of this year. So US equity market was basically flat for the quarter. And however, the US market outperformed international and outperformed emerging market sectors. Value underperformed. So you can see that large cap growth. So large cap growth, these are large US companies that are more growth oriented. So you might think in terms of Amazon, of Apple. These are not necessarily exclusively technology companies, but primarily technology companies. And they had a strong quarter. You can see that small companies, again, this is something that I've been talking about quarter after quarter. Small companies have lagged large companies for a number of years. And you can see that down here, actually, where you're looking at, let me bring this up, you're looking at large cap growth. So if you look at let's look at a longer term, let's look at 3 years or 5 years. You can see that over that time period, large cap growth in the US has absolutely been the best performing asset class in terms of stocks to be in. Much better than small cap value or small cap growth or over that same time period. So just as a sort of a rule of thumb over the last 10 years or so, we have been stronger proponents of large US-based companies versus international or emerging market and over small companies over that period. And there are a lot of reasons for that. And fortunately, over the last decade, it has been the better asset class to be in, large companies versus smaller companies. And we expect small companies to, at some point, rebound. We've seen a little bit of that this year in terms of looking at small cap value. That has been really an underperforming asset class for many years. You can see that play out here over the 3-year period. In fact, it was the worst performing asset class. This year to date anyway, it has regained a little bit. It hasn't been enough. And we think that over longer periods of time, large companies are less volatile, and we think will continue to outperform smaller companies over longer periods of time. We can look at, so this is the big topic that I alluded to earlier, and that is looking at inflation. So inflation is measured generally with the consumer price index. So consumer price index, CPI, uses a basket of goods and services to basically track the change in prices for those things over time. And usually what happens is we look at core CPI. So core CPI, again, it's a basket of goods and services, but it excludes food and energy, because food and energy are much more volatile. And so to get a better sort of long-term picture, more stable picture of where prices are, core CPI removes, again, both food and energy from the basket of goods. And you can see here, we are at multi-decade highs in terms of the consumer price index, in terms of inflation. We haven't seen a level this high since really 2009, 2008, and that's where it most recently peaked. And then again, going back, we can go back all the way to 1990, 1991. And so what does this tell us? You can see that this rapid, from basically a flat line, this rapid rise of inflation. And how is this going to affect the markets? How has it affected the markets? I'll show you on this next slide what we're looking at here. So it affects it in terms of interest rates. So interest rates have, again, like inflation, bottomed out in 2020. We saw here And then we saw this fast acceleration of the 10-year interest rate. 2-year really hasn't changed, been pretty static. What we're looking at here, and generally speaking, when you're looking at interest rates, you're looking at the 10-year treasury. And we saw that the bottom was about 0.5%, 0.5%. And then we saw this over a very short period of time, this rise to, it got close to 2%. We've seen it come back down, but most recently we've seen it come back up here. And the reason for this is because inflation and inflation fears. And what we expect is that rising long-term interest rates are often a sign of an early phase of a business cycle, but at the same time, it can have negative effects, especially in terms of fixed income portfolios, so bonds. So bonds actually do worse when interest rates are going up. There's an inverse relationship. And that's why it's been very, I would say, challenging in investing in bonds over the last couple of years, primarily over the last year. Most people think bonds are pretty safe, secure, stable. They don't move very much. It's a very secure investment. And generally speaking, they are. But there are many different flavors of bonds. And if you are in the wrong flavor of the month, if interest rates go up, you can be negatively impacted. The value of those bonds will decline. So we've been very defensive over the last year or so. With interest rates being so low, there is very little room for them to continue to drop. And so bonds do really well when interest rates are dropping. And we got to the point where there was very little upside left. And so we became much more conservative with our bond portfolios, having the bond portfolios be much more high quality and also a very, very short-term duration. Because what happens is if you have long-term bonds, those do worse when interest rates are going up than very short-term bonds. And we can see this right on this slide. 10-year bonds, interest rates go up. 2-year bonds, interest rates stay about the same. And so we became much more defensive. And so far, it's been to our advantage in doing that. We can also see this slide shows the leading economic indicators over a period of many years. And what typically happens is that the indicator usually, not always, but usually turns negative a month or several months before a recession. And so this happened here where the leading economic indicator in orange turned negative before we saw the recession areas are in blue or in this gray bars here. And so you can see leading economic indicators turned negative before recession. Leading economic indicator turned negative before the recession. We see this time and time again. What made 2020 and COVID and the drop and the recession we saw there so interesting was just the speed at which it occurred. So we saw this decline almost simultaneous to the recession that we saw. But just as interesting, we saw this sharp drop and then an immediate rebound. And if you look at where we were and even where we are currently, this is at, again, multi-decade highs in terms of leading economic indicators. I say this with almost every slide, but this I think really is my favorite slide. And what this shows is the blue bars represent the return of the S&P 500 over a particular year. So you can see, for example, in this year was 2008, you saw this decline of 37% in the S&P 500 for that year. So from January 1st to December 31st, the S&P 500 declined 37% for that year. And so 2009, you can see this market was up for the year, 26%. So these red dots, and this is what makes it so interesting, this represents the intra-year decline for the S&P 500. So using 2008 as our example, the market at one point during that year was down 48%. It then recovered almost 10% to close at negative 37% for the year. So you can see a couple of different things. One is that more often the market produces a positive return than a negative return. We've had a few over the last couple of decades. We had one here. We had 3 in a row here. This was the tech bubble that burst, and we had 3 negative years in the S&P 500. We had one in 2008, and we had one in 2018 that occurred here, and 2017. And then what is most interesting is that in 2020, look at this, COVID hits March 23rd of last year, the market had dropped 34% in a matter of weeks, market down 34%. But from March 23rd to December 31st, the market miraculously increased and actually returned a positive return of 18% for 2020. And so this is why it is so important to focus on the long term. Trust me, and I know you know, down 48%, down 34% in a couple of weeks, down 19%. This can be scary. It can be hard to look at the portfolio and when your portfolio is down and to want to stick with it, especially if we see multi-year declines. It takes a certain kind of an investor and to be able to withstand that and to be able to stick in there. But time and time again, even with negative returns, that often the market will either produce a positive return or a less negative return, if that makes sense. And so that's why it's important. Stick with it. We saw in 2009 another big drop early in the year, only to return a positive 26%. So all that is to say, we have to be patient. We have to be able to ride out the volatility. And if we can, then the gift to us is over a longer period, positive returns. And this is another great slide because it just shows the futility in trying to time the market. You can see here, look at commodities. From the last 10 years, commodities have just been a terrible place to invest. And so, we have not been a fan of commodities for a very long time. One of the worst performing in 2011, the worst performing asset class in 2012, 2013, 2014, and 2015, negative returns every single year. Then we saw a bounce, it came back up in 2016, only to drop back down to the worst performing asset class, a negative return in 2018. In 2019, 2020, the worst performing asset classes. Now this year, look at this jump that we've seen. 33%, the best performing asset class so far. That could change, but so far of 2021. You can see that we can't look at what's the best performing in one year and then try to mimic that the next year, because the asset classes change so dramatically that it just doesn't make sense to try to look back at history to try to determine what tomorrow is going to bring. And so that's why having a diversified portfolio, rebalancing at appropriate times, tax loss harvesting, and really sticking to your plan is really the best type of investment strategy, rather than trying to jump in and out of different asset classes. So I hope you've enjoyed this presentation. Attached to the email, you should receive this presentation in PDF format as well. You can also download and look at the performance of your portfolio, not just for the third quarter, but for any time period, really. You can dial in whatever time period you want and see how your portfolio has done. If you have any questions, if you want to talk further, about the market, about the economy, or about your portfolio, feel free to reach out. I would love to have a conversation with you. And until next time, I hope you have a great fall. Thanks so much.